Investing in undervalued stocks is generally considered to be one of many strategies that an investor might use to their advantage when starting their career. But the thing is, for most of us, not investing in undervalued stocks might be the single biggest mistake of our investing career, and we might not even realize it in time. You see, when you first get into the investing world, the most tempting thing to do is to just pour your money into the most popular stocks and wait for it to slowly, painfully make a return. But unless you have a huge capital or tens of crores, you're not going to make any money anytime soon.
और मुझे ये भी पता है कि जो आप लोग ये वीडियो देख रहे हैं या तो ये बात पहले से रियलाइज कर चुके होंगे जब आपको प्रॉफिट्स नहीं हुए या बहुत जल्दी रियलिटी चेक आपको भी मिलने वाला है.
And that leaves us with one question. ना हमारे पास पैसे ज़्यादा हैं, ना ट्रेनिंग इतनी कि प्रॉपर वैल्यू इन्वेस्टिंग कर सकें. तो इस हालत में क्या किया जा सकता है? Well, my friends, that is what we'll be talking about today. Because while you might not become Wall Street investors anytime soon, there are just a handful of small steps that if you incorporate into your investing life, you will see your situation change before you know it. And you better hang around till the end, because by the end, we will give you not one, not two, but 3 mathematical tools to turn you into professional investors who can identify undervalued stocks within seconds. The system. Getting to the main subject, in this video, for your convenience, we have created a list of 5 simple, easy-to-follow steps, each with a time limit and an end goal for you to achieve. And if you follow all of these to the very end, you should be able to invest in good, profitable stocks that are not just undervalued, but will actually give you a sizable return. So without further ado, let's start with step number 1, screen potential targets. Now, for most investors, this is the most important step of your entire investing process, and that alone is often the reason for their downfall.
असल में बात यह है कि अक्सर इन्वेस्टर्स ये सोच के बैठ जाते हैं कि जो अच्छी कंपनी कहीं से मिल जाए उसमें बस अंधाधुंध पैसे डाल दो.
When in reality, actual successful investors will take a much more organized approach. And the first step of this approach is finding 20 to 40 potential companies that all have a few characteristics in common. A. They're not super new or sketchy. They come from reputable sources. B. They're not too volatile or too hyped. And most importantly, C. They all have a low EPS ratio. And that is it. At this stage, you won't worry about their business models, industries, management, or any of that. All you have to do is to go to one of the dozens of market research websites like Guru Focus or Yahoo Finance for international stocks or Markets Mojo, ya Screener.in for Indian stocks. Find a page of promising ones and rank them by their EPS ratio. Then you select some of the good companies you see and check them against the following criteria. They should have a return on equity of greater than 15%, a debt-to-equity ratio of less than 0.5, and a current ratio of greater than 2. If a company fulfills these criteria while being trustworthy and having a low EPS value, then you add it to the list. This way, before you know it, you will have a list of 20 or so companies that you have narrowed down from an infinite list of possibilities. Add to those some stocks that are recommended by trusted publications, and these analysis websites themselves, and it shouldn't take you more than 4 days. And now that you have your list, we can start applying more in-depth technical tools to narrow down our search for stocks further. But before we get into how exactly we're supposed to do that, if you're liking the video so far, I'm sure that you will also find the rest of our content interesting. And if that sounds like something you're into, feel free to subscribe to our channel for more practical financial advice in a world full of random, unhelpful videos. And while you're at it, give the video a thumbs up as well. It goes a long way towards making our videos reach more viewers, such as yourself. And now with that done, let's move on to step number 2. Create a short list by using undervaluation criteria. This is probably going to be the longest and most complicated part of your investing process. And the reason for that is कि अब आपने इन 30 companies में से एक-एक करके वो companies eliminate करनी हैं जो ज़्यादा suitable नहीं. And to do that, you will have to not only check metrics like the company's debt to current asset ratio, their S&P rating and others, but you will also have to look at the company's internal and external mechanics to ascertain if the stock is actually undervalued. For this, you'll check the business models, products, market trends, company management, and everything else that makes a company successful or unsuccessful for each of the stocks you selected in the previous step. Along with these, you will also look at things like the company's S&P rating, which is generally considered the higher the better, but at the very least should be over B+. Similarly, there are other metrics like the P/E ratio, which should be less than 9, the debt-to-asset ratio, which should be less than 1 to 10, the current ratio, which should be around 1.5, and so on. And as you go through your list, first eliminate the stocks that fall short of any one of these standards. Then as you narrow down the list further, look at the company's management, newsletters, financial statements, and everything else you can think of, to in the end, find the best 3 to 5 stocks from your original 30. And sure, you can accomplish all of this in a few days, but I'd recommend that you spend a day researching 1 or 2 stocks at most, and only consider this process over once you have thoroughly researched each and every one of your options. This will ideally take you 2-ish weeks, but the end result will make the difference between your success not just now, but in the long run. And speaking of the now, once you have your short list of stocks that you're sure are undervalued, it's time you move on to the next step. Step number 3, estimate the organic value and margin of error. Most people, once they have created a list like this one, will just throw caution into the wind and jump to investing. लेकिन आप लोगों ने ये गलती हरगिज़ नहीं करनी, क्योंकि सही स्टॉक्स तो हजारों लोग ढूंढ लेते हैं, लेकिन वो सब उस खेल में मारे जाते हैं कि इन स्टॉक्स में कैसे इन्वेस्ट करें कि एक्चुअल टैंजिबल प्रॉफिट्स हों. Because to effectively make profits, you don't just need a good company. You need to check how much you must invest for those profits and whether investing the money right now is a good idea at all, and if instead you should sit on your choices for a bit. And to figure out these things effectively, I recommend a set of very impressive tools that have helped the likes of Warren Buffett generate their profits. You see, in his world-famous book, The Intelligent Investor, Benjamin Graham gives us the concept of an investing margin of error. This is the difference in the cost of a stock and its actual internal worth, or in the case of undervalued stocks, it is the measure of just how undervalued the stock actually is. And not only does this ensure even greater profits in the future, but it also makes sure that even if the stock does not appreciate in value that much, just because you paid it for below its actual value, you will still come out with a profit instead of a loss. And while the only real way to accomplish this is through rigorous research, not to mention a ton of experience, the next step should help. Step number 4, apply value formulae. To see how to calculate the value and determine the appropriate margin of error, we shall look once again at investing legend Benjamin Graham, who in his book says that one must invest in stocks only if their asking price is at least 20% below their intrinsic value. What is this intrinsic value then? Well, that is the actual internal worth of a company based on how good of a business it is. And while it is usually very difficult to understand, for our purposes we can calculate it using another one of Graham's formulas. Intrinsic value, EPS times 8.5 plus 2 times growth rate. Both of these values, EPS and growth rate, can be found out using a simple Google search. And once you have this measure of intrinsic value, you can compare it to the asking price and see the difference. And by doing this, you will know exactly how much you should be investing, or if the value is not that low, if you should look at another stock instead. All of this should take barely a day, and you should try to do it quickly too, because if there is one thing that you can count on with the stock market, it is the fact that stuff changes fast. But if the stock is correct and the value is just fine, then there is but one step left before you can start making money. Step number 5, time the investment. This is the part of the process in which we more or less borrow techniques from traditional investing, because at this stage, all you will do is wait for the right moment to invest, as we just learned how to do it in the last step. But there is also a matter of how and when you will take out the money, how often you will invest in change stocks, and when you should abort the investment entirely. And while it is, once again, a very complicated and continuous process, a few techniques help us in this regard as well. One of them is the dollar averaging strategy, in which you don't invest your money all at once, but invest in small amounts spread out over a long period of time, giving you a greater chance of investing the correct amount. As for the rest of the tricks and methods on how to constantly and correctly time investments, you will have to watch one of our other videos. But as long as you follow the averaging strategy and keep a consistent margin of error on all investments, you should be able to invest through any one of the finance services of your choice. There are a ton of tutorials on how you can actually start an investment portfolio through a website or even your bank, so we won't get into that. But considering that you finish your research in 4-ish weeks, you should have investments started by the end of the 6th week. And that's about all there is to it. Now, if you've done everything correctly and followed each and every one of the steps we have described up till now, not only will you have a comprehensive, confident list of value stocks before the end of this month, but you will be able to apply these rules and principles again and again in the future, no matter how the market changes. And sure,
Some of your early attempts might not be as successful as you hope, but as long as you avoid any massive losses and keep practicing before you know it, you too will be looking at a comfortable, lavish retirement starting well before when it would have had you kept investing regularly. And that covers our simple guide on how to find and invest undervalued stocks that will actually make you rich. And with that, we must pass the question off to you. What do you think is a better investment strategy? Long-term with low risk and low returns, or short-term with high returns but high rewards? Do let us know what you think in the comments, and don't forget to talk to others like yourself. And if you've managed to stay on till now, I'm sure you will also enjoy our other videos on these kinds of topics. And if you want to learn more, click on our more in-depth video about undervalued stocks by clicking on the screen right now. And well, on that note, we must end today's video. I hope you enjoyed watching it, and if you did, be sure to leave a like and subscribe for more. With that, take care, and I'll see you guys next time.